Okay, so let's start to play around with some of these useful diagrams. In the first half of this reading, we put together our aggregate demand, our aggregate supply in the short and long run. Now let's see how we can use all of those curves to work out what's going to happen to our economy if we're in equilibrium or if we end up in a hopefully a short run disequilibrium. So let's start off here with a short run disequilibrium where we are either on the left below or on the right above full employment. Starting on the left, what do we have in these diagrams? On the horizontal axis, we're looking at real GDP, what we've been labeling Y so far. And on the vertical axis, the price level in the economy. We have, as discussed, a downward sloping aggregate demand. We have an upward sloping short run aggregate supply. Remember, in the short run, the firm's input costs are fixed, hence the upward slope. The long run should be fixed at the full employment level of equilibrium. And what we're doing here is kind of justifying why. If we find ourselves here below full employment equilibrium in the short run at GDP 1, what we've got is an output gap. That output gap causes unemployment. So we're below full employment equilibrium. GDP is lower than potential GDP, lower than full employment GDP, and we have an output gap and unemployment. So what should happen in the long run? Well, the theory at least is this. In the long run, if we have unemployment, wage demands should fall. Wages are a key part of a firm's input prices. A reduction in those wages should therefore reduce the cost base for the firm and shift the short-run aggregate supply curve. Now, if their input prices are dropping, that curve is going to shift down. It'll look like it's going out to the right. As there's downward wage pressure, that curve shifts out to the right to bring us back to equilibrium and remove that output gap. That's the key mechanism. Doesn't matter where we start, the idea is we end up back at full employment. What if we're out to the right? Well, out to the right, we actually have more than full employment GDP. How is this possible? Well, the firm is just asking people to work longer hours without paying them more. We're running our machinery harder. We should shut down production lines once a month. We're not doing it. We're squeaking an extra week out of them without maintenance. That can happen in the short run. However, in the long run, there will be upward pressure on wages. That will increase the cost base, and hence upward wage pressure brings that short-run aggregate supply curve up or back to the left, forcing us again back to full employment GDP. So the key is this: it doesn't matter where we start, our equilibrium ends back up here at full employment GDP. That's why your long-run aggregate supply curve fixed vertical at that full employment GDP. I say fixed, let me just refer back again. Hopefully our economy grows and we can boost that GDP, full employment GDP, POGO out there. Only do that by increasing the labor supply, the capital, or technology. So we've looked at a short-run disequilibrium. That's the impact, or the mechanism, I should say, to try and shift the short-run aggregate supply curve to get us back to equilibrium. What if we start to play around with demand and the aggregate demand curve moves? How does that affect our economy? Starting off, this time in equilibrium at our full employment GDP. Now, for some reason, and we saw a list earlier on of all the possible reasons, anything that shifts C or I or G or X minus M, we have a shift in aggregate demand. Let's start off with an increase in aggregate demand. So if we increase aggregate demand, curve is going to shift up to the right, and we end up with a short-run equilibrium out here. This is pretty much our starting point, or one of our starting points on the previous slide. But for the exam, you could well be asked a question that says, what happens if we have an increase in aggregate demand in the short run? And a good rule of thumb is this: in the short run, everything changes. So in the short run, GDP increased beyond full employment. Prices went up. Even though we were at full employment GDP, there are more hours being worked now. But not all of that will stick in the long run. Remember our mechanism? If we're in this short-run equilibrium, upward pressure on wages will cause the short-run aggregate supply curve to shift back, and our long-run equilibrium is back at full employment GDP. The only thing that changed in the long run, price. So in the short run, price went up, GDP went up. In the long run, it's only price. We can do the same for a decrease in aggregate demand. Starting at our full employment GDP, everything's going swimmingly. For some reason, we see a weakening in aggregate demand. That means the aggregate demand curve shifting back to the left. So lower demand at every price level. Once again, the rule of thumb will hold in the short run. Everything changes. The price dropped. GDP fell. We've got an output gap. We've got unemployment. Prices dropped. GDP fell. Unemployment rose. But we have downward pressure on wages. Downward pressure on wages will reduce the cost base of your firms, hence shift the short-run aggregate supply curve back to the right. Money wages fall, we get back to our long-run equilibrium at full employment GDP. Once again, the only thing that's changed in the long run, price. Short run, everything changes. Long run, only price. They are the key basics of macroeconomics with these diagrams. There are a couple of extra points we can talk about because these diagrams make it look like, yay, everything's great and we'll never end up stuck in a disequilibrium. Of course, we know that's not true. But another problem we can talk about is stagflation. Stagflation. What have we got with stagflation? Well, inflation and unemployment. When does this happen? Well, if we trace through the movements here, we're starting off at AD0 and short-run aggregate supply curve 0 at this equilibrium. Once again, at full employment, everybody's happy. But this time, we're not increasing or decreasing aggregate demand. This time, what throws us out of equilibrium is a supply shock. A decrease in the short-run aggregate supply curve, a shift upwards. Why does that happen? Well, supply shock, price of oil doubles, let's say. Massive increase in firms' cost base shifts the short-run aggregate supply curve back and to the left. Less supply at every price level, which means new equilibrium between your new short-run aggregate supply curve and the original aggregate demand is here. What do we have? Well, distressingly, an output gap and hence unemployment with rising prices. Unemployment and inflation. That is an issue. Output declines and prices rise. What do you do in that situation as a government? Well, pretty much pick your poison. The problem is you can address the inflation, you can address the recession, but you can't hit both. For example, let's imagine you wanted to address the recession. We're sat here now due to the supply shock. Prices have gone up, GDP fallen, output gap and unemployment. The government could choose to intervene, kickstart the economy. Back to our list of things that influence aggregate demand. We said an increase in government spending, a decrease in taxes, an increase in the money supply would all boost aggregate demand. So the government could choose to do that. Let's address this recession, the output gap, the unemployment, by kickstarting aggregate demand somehow. So let's say we could use fiscal policy, we could use monetary policy. We'll do that. We'll kickstart aggregate demand to AD1 and everyone's happy. New equilibrium of AD1, the new supply curve, we're back to full employment GDP. The downside, we've just raised price levels again. We've addressed the recession. We've made the inflation worse, if anything. So it's a problem. Stagflation is unpleasant. It takes a long, difficult time for wages and input prices to fall. That's really what we're looking for. We don't want to boost inflation, make it even worse. We just wait for the supply curve to come back down. So you see a doubling in the price of oil. We need to sit back and wait for firms to deal with it, find alternative sources, be more efficient, get their cost base back down again. That's stagflation. Okay, a summary. So we've seen most of the big diagrams, pretty good stuff. Now we just look at every single possible combination of movements in aggregate demand and aggregate supply and the impact on the price level. This kind of question is why I think those diagrams are pretty useful. Remember, if aggregate demand increases, what you're seeing with an aggregate demand increase is the aggregate demand curve shifting out to the right. It's effectively going up. It looks like it's shifting out to the right. For a decrease, you're seeing it come back to the left. So out to the right for an increase, back to the left. Aggregate supply, if it increases, short run aggregate supply, if it increases, it goes out to the right. If it decreases, coming back to the left. So if you've got those in your head and you can kind of picture, and just in the exam even, I would scribble down the diagram. If I did the exam again today, I would write the diagram down, make sure I got it right. Let's start with the easy ones, because I think they're down here. If you have an increase in aggregate demand and a decrease in aggregate supply, what happens to the price level? Well, it's very easy to say the price level is going to increase. Why? Well, aggregate demand has increased, pushing the aggregate demand curve. So AD, it goes out to the right. We have a decrease in aggregate supply. So if we started here, supply curve is coming back to the left. We start off here, we end up here. Price level has gone up. Opposite is true if the aggregate demand curve decreases and aggregate supply increases. We're effectively going from 2 back to 1. The price level drops. I just think it's easiest to think in terms of prices. I think that's a good jumping in point. The problem is we don't know in those situations what happens to GDP. So you'd have to look very closely at mine there. I think the way I've randomly drawn it, GDP has just about crept up. But depending on how much I move those curves, for example, if I move my supply curve a lot more, then the equilibrium will be back here. So in that case, you know what happens to price. It's not quite so clear-cut what's going to happen to GDP. And then move to the top two. Same sort of argument if you look at the top two, but this time it's easy to see what happens to GDP. So we take the top example, an increase in aggregate demand and aggregate supply. So we start off here, nice equilibrium, supply demand. These are aggregate, I'm just not labeling them. Increase in aggregate demand, well, shifting out. Increase in aggregate supply, shifting out. We started off here. Our new equilibrium is here. We are increasing GDP. But once again, what happens to the price level depends on the amount of movement. We don't know. And again, for a decrease in both, it's the opposite. We go back this way. GDP decreases. Don't know again. Price level depends on the relative size of the movements. So it's quite a nice summary. I like that to put into your review notes because it tests if you remember which way the curves go in terms of increasing and decreasing. Okay, sources of economic growth. Well, great news. We mentioned this earlier in the reading. These are the exact same factors that increase the long-run aggregate supply curve. Remember, the long-run aggregate supply curve is vertical, fixed at full employment GDP. The only way you can make this pogo jump out to the right is by boosting full employment GDP, i.e. economic growth. So here's the list again. The amount of labor you have, the amount of capital you have, or your level of technology. That's it. And the great news is, the end of this section starts to talk in a bit more detail about your labor and your capital and your technology levels. Where does this growth come from and how do we see it? Well, here we go. Sustainable growth. Potential GDP. So potential GDP, full employment GDP, this level that I keep talking about here for the long run aggregate supply curve, where we should be in equilibrium. That is aggregate hours worked multiplied by labor productivity. Growth will therefore be the growth in the labor force plus the growth in productivity. Where does this come from? Levels of capital and technology. Why are we interested? Well, long-term equity returns are dependent on having sustainable growth. If you don't have growth in GDP, don't have growth in the output of the economy, that means we can't have constant growth in equity. It's dependent on having sustainable growth. So it's worth being able to calculate. And here's an introduction to a simple production function. No real detail on kind of numbers or what the function is in here. It's just a nice overview. Sets the scene beautifully. It says your output, Y, is some sort of function of your inputs, and we're assuming here just two inputs, labor and capital. Multiplied by A is your TFP, the total factor productivity. If you ever see TFP in any model answers for questions you're doing, it means the level of technology, A. That's the increase in output, not from an increase in labor or capital, but the increase in output from advances in technology. So for the same level of labor and capital, you can get a higher output with a higher level of technology. Now what's useful is to work out where did our increase in output come from. Typically in the real world, we know what's happening to output. OECD will measure it for us. We can see how our GDP grew. Fairly straightforward to work out our growth in labor and capital. What's not so obvious is how much our technology advanced. So we can start to try and build some formulas together to work that out. So another quick measure of progress is output per worker. I mentioned this kind of because it's quite important. I mean, it's in your exam, but keep saying, and I keep mentioning that GDP is huge. Really, if you want a measure of standard of living, the key measure is output per worker, GDP per capita, if you will. That's a genuine measure of the standard of living. Well, the production function then, if you divide by L, says it's A, your level of technology, times a function of capital per worker, K over L. So K over L, capital per worker. And this is a good point. Old friend, diminishing marginal returns, this time diminishing marginal productivity. It says because of diminishing marginal productivity of capital, progress in developed countries relies really on technological advances. In other words, if you're in a developed economy, capital per worker is typically already very high. Any further increase in capital per worker will increase GDP, but not by much. So as you get higher and higher and higher levels of capital per worker, GDP will increase at a decreasing rate. Think of it like this. So at very high levels of K over L up here, hardly any increase in GDP for an increase in K over L. Therefore, if this doesn't have much of an effect, you're relying on technological advancements. Well, compare that to developing. Developing tend to have very low levels of capital per worker. So capital deepening, as I'll call it, increase in capital per worker, can give you a real boost to GDP. So worth comparing and contrasting developed to developing. Now the numbers mentioned earlier on, it's quite nice to be able to find out how much of my economic growth was due to advances in TFP, the A, the technology level. Well, here's a nice little formula. Growth in potential GDP, which we typically know, can be calculated as the growth in TFP, which we're trying to find out, plus WC into the growth in capital. Growth in capital were given to us typically just as a percentage. WC, it's the weighting of the factor's share of national income. So how much of our national income goes back to capital and how much to labor? So for example, we'll see in our example, in a standard example, typically 30% goes to capital and 70% to labor. Obviously there are two weightings. If you've got two factors, they add up to one. And again, we'll know the growth in labor. So if we know the growth in GDP, we know the weightings, and we know the growth in capital and labor, we could balance back to our growth in TFP. Another way of looking at that formula, if we want to do it per capita, well, that's just the growth in technology plus percentage of national income that went to capital times the growth in the capital to labor ratio. And there's that point again. Diminishing returns. We said if it's already very high, you don't get much growth developed. Therefore, you need technological advancement. Good stuff. It sets up the production function quite nicely. We've got all the key macro diagrams, which are huge, and then a couple of formulas that you do just need to learn at the end. You might just have to throw some numbers at that.